Welcome back to my YouTube channel. Today I'm going to be reviewing the NR-4 strategy, which I had shared with you all in my first video. So in order to trade NR-4 strategy successfully, you must consider these variables and then follow rules upon those variables. So what are the variables? The number one variable is you will have random amount of trades in a particular given day. So basically, few days you will have 4 trades, few days you will have 1 trade, few days you will have more than 10 trades. So this is a big variable and it affects the capital deployment and the overall risk or return you make on a particular day. Okay, so what you need to do, what rule you need to follow in order to terminate this problem is you have to divide the number of possible trades. You have to divide the deployed capital, overall deployed capital, by the number of possible trades in a particular date, and according to that you have to take 2%. The standard risk management rule is that you should not exceed your risk by 2% in a particular trade. So you have to divide, let's say I'm assuming that there is a capital 10 lakhs rupees which is accessible for you to deploy in NR-4 strategy for a particular day. It's an intraday strategy. So on 31st of January there were 4 number of possible trades. The best thing about this strategy that you already have how many maximum stocks you will happen to trade for the next day, because that is shown in the scan a day prior. So on 28th January NR-4 scan, you have 4 stocks were in your criteria. So basically you had to deploy 2,50,000 rupees to each trade, and on top of that you will know that how much risk per trade you have to take, as 2% of the 2,50,000 will be 5,000. So whatever stocks you will be trading on 31st of January, you will be risking only 5,000 rupees, and on behalf of that, in 2,50,000 rupees you have to risk only 5,000 rupees each trade, and you have only 2 possible trades which got triggered on that day. So HCL Technology and TCS both were showing you the buy trigger that day. Both had broken out their highs, and the stop loss value is nothing but the entry price and the initial trigger. So in HCL Technology, the entry price was 1102.25 and exit trigger was 25 rupees 5 paisa below the entry price, buy price. But you have to close the trade at 315 or at stop loss. This is the important rule you need to follow. Second rule is that your exits, either your exit must happen at your stop loss or it must happen at the closing of the market at 315 or 320. In that case, today in today's scenario, a lot of brokers are allowing you to hold the trade till 320. So I have considered 320 in all of my exit prices. So either at stop loss or at the 320 market close. So in case of HCL Technology, the closing happened 320 closing happened at 1099.55. So the position sizing we had initiated in the stock, according to that we made a loss of 537 rupees, and there were charges of 127 rupees in that stock. So ultimately on that day TCS and HCL had made us a loss of 1330 rupees, and 250 rupees you have to add in the overall losses, because this is the gross P&L and the charges will be included in your brokerage reports. So basically you made a loss somewhere around 1600 rupees on that day. On 1st of February, the number of possible trades in the scanner were showing 10. So on a particular trade, you have to deploy 1 lakh rupees to each trade, and on behalf of that you have a risk of 2,000 rupees in every single stock. Now you have the risk you have to take in a particular trade, so that will be easy for you to calculate the position size you have to initiate, because you already know the stop loss value, because in most of the cases the stop loss value is the difference between highs and lows of the NR-4 day. If market does not open gap up next day and you do not need to buy at 9:15 on the open price only or sell at the open price only, you already know it in most of the cases that your stop loss value is this much. Okay, so in case of Adani Ports, your stop loss value of value was 9 rupees 45 paisa. So according to the risk which you had to take is 2000 rupees in this trade, you had to initiate a position sizing of 211 rupees, 211 quantity you had to buy here, and at the end of the 320 candle you made a profit of 3428 rupees. So on 2nd of February, then 3rd of February, the list is available here. You can check it out by pausing the video. And at the end of this particular backtest report, till 7th of February, on 7th of February there was only one stock available in your criteria, so you had to deploy the whole capital and you had to take 20,000 rupees risk in that particular stock, HDFC Bank. The stop loss value was 20 rupees 80 paisa. You sold it at 1512 rupees 10 paisa and you bought it back at 1467 rupees 40 paisa. So on this quantity you will be able to make 42,956 rupees in any trade which has this metrics. Okay, so at the end of the backtest report, the overall profits we had made here is 69,840 rupees, as I had considered a capital of 10 lakhs rupees. So the percentage gain of capital was 7% somewhere. Total trades happened in the strategy was 27. Out of those 27, 14 were winner and 13 were losers. So this strategy is giving you a win rate just slightly above 50%, and positive expectancy of the strategy is 0.19%. What is expectancy? Expectancy is nothing but R multiple divided by total number of trades. What is R multiple? R is the initial risk you take in a particular trade, and whatever the end result will be, according to that the R multiple will be calculated. For example, in this day on 1st of February, Adani Ports, we made a profit of 3,428 rupees 70 paisa minus this, but our initial risk, the R, was 2,000 rupees, but we made a profit of somewhere 3,327 rupees. So that was 1.66 times the initial risk we had taken in the stock. Okay, so whatever system which gives you a positive expectancy from 0.2 to 0.6 is a good system. Above 0.5 or 0.6, that is an excellent system, but according to me this system can be traded, but I will recommend you to deploy only 30 to 40% of your overall intraday capital on this strategy, and just forward test it for next 5 to 6 months and make sense on your own, because I'm just giving you this strategy, but overall you have to do your own due diligence in this strategy and you need to make a comfort with it. Okay, it's not like I have just shown you the statistics and it will appeal you and you will start doing trades on behalf of this strategy. All I understand is you need to make your own comfort with the strategy, because a lot of days it will happen when 10 or 15 trades will happen in the system, but still you will just stay above the ground. I mean, you will at the break even. Just look at these 2 days. There were 10 stocks, 10 possible trades were there, and you only made 2,798 rupees after 10 trades happened. Almost 5 or 6 stop loss had hit that day. So days like this, if you do not have a comfort with the strategy, you will not be able to trade it for long. But if you just had seen this and you will make a sense in your mind that whatever trades will come under this strategy, there is a very low chance for it to work. You will miss a very big winner the next day if you just had decided not to go with it. So Basically, this is very important for you to make a comfort with it. Okay, and last but not the least is you have to take all the trades in the strategy, in the given strategy. If you will see the report, there were two big winners, this one and this one. If you just had missed these both trades and you actually deduct the amount made by those trades, the strategy will be a net break even or loser even. So this strategy will not make you any money even after 25 trades if you just terminate the big winners out of the strategy. So basically, you do not afford in this strategy to even miss a single trade. And if you just have to take care of this problem, I recommend you to go with algos, because it will help you in doing all the trades automatic. It will automate your strategy. It will give you the convenience to just turn on the robot, and robot will take care of the part of the position sizing, the exits, and to take all the trades, because there won't be any manual involvement happen in the trades. So you will not be having any sort of emotions also. It will also help you on that case. So I would recommend you to take and consider the algo options if you have to go with this strategy. It will help you a lot. Okay, these are the metrics. And another thing which I wanted to tell you is that we have to see how indices performed on the particular days. This is also a big winner. How indices performed on those particular days when and we will compare how our stocks also performed. Okay, so on 31st January, this was a choppy day. It is a very difficult day for intraday trend followers, because it will not make you money. Either your stop loss will be hit, or you will end up at a small loss or profit, or at break even. So this day will not appeal an intraday trader, right? An intraday trend follower trader. On 31st January, we risked 5,000 in 2 trades. So our overall risk was 10,000. How much profits or loss did we make? We made a very small loss of 1330 rupees, and after adding the charges, that was somewhere around 1600 rupees. So on a risk of 10,000 rupees in a choppy day, which is not good for us to trade, still we were able to only lose less than 10% of 2% of the overall risk we had taken that day, 20%. On 1st of February, it was a very volatile day. First, market made a high, then made a low, then again made a high, then again made a low, then it ended around highs. So it was a very difficult day to make money for every trader. Just a minute. Okay. So it was a very difficult day even for an option seller or for a trend follower. It has been a very difficult day for those sort of traders. Then 2nd February, choppy day. First we will see how our stocks performed on the 1st February. On 1st February, we made good money. I mean, it wasn't very good, but we didn't lose money despite it was a very, very volatile day. 3rd day, it was a choppy day. Again, you will very rarely make money on these sort of days. Let's see how our strategy performed. On 2nd of February, only one stock triggered. Only one possible trade was about to happen that day, and we made a killing amount of money, because our risk was also bigger that day, because the possible trade was only one on that day. 3rd February, it was a mild trending day. On 3rd February, we made good amount of money. It wasn't that big, but number of stocks which triggered the entry were 9, and those 9 stocks were able to make us a small amount of money, small amount of profits we made, but still we ended a profitable day. We ended as a profitable day that. On 4th of February, the market was again choppy. Did we make money? Let's check. Yes, we made a bit of money. And on 7th of February, only one stock was in the scan a day prior, HDFC Bank. It made a killing amount of money. It gave us R multiple 2.11. So it was a very awesome day for a trend follower, and HDFC Bank had given you a very good amount of profit that day. So basically these are the statistics of this strategy. So it will help you to understand whether you should go with this strategy or not. I will recommend again you to go with only 30 to 40% of your capital which you have to deploy for intraday, because you need to make a comfort with it by forward testing it, by trading it in live market with real money. So this is where the comfort will come. This is all about the backtest report of NR-4 strategy, and I want you guys to give me the honest feedback of yours. How did you like the video, and what topics do you want do you want me to make content upon? That will really help me to understand what should I deliver to you, what will appeal you. Thanks a ton. Thank you.